Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Netflix.
If you find our talks useful, please consider subscribe, like, and comment underneath. So let's get right into it. It is mid-February 2026.
Yep.
We are barely 6 weeks into the new year, and if you are holding Netflix stock right now, you might be feeling a little queasy.
Queasy is putting it mildly. This hasn't been the start to the year that the bulls were really getting on.
No, not at all. Looking at the charts, the mood is definitely tense. The stock is down about 16.6% year to date.
And just in the last month.
Just in the last 30 days, we've seen a drop of around 16%. I mean, that is a significant haircut for a company that usually leads the pack.
It is. But, in this game, context is everything. This isn't just a random sell-off because, subscribers suddenly hate streaming.
Right.
Or a show flopped. The market is reacting to a very specific, very massive elephant in the room.
Yeah, the rumor mill is absolutely on fire. We aren't talking about a bad earnings report. We're talking about a potential acquisition that could, well, fundamentally reshape the entire media landscape.
That's the headline dominating every terminal right now. It's this potential all-cash amended deal for Warner Bros. Discovery, and that is exactly what caused this gap down in the price.
Can you explain that, the gap down?
Yeah, for anyone not staring at charts all day, a gap down is when the price opens way lower than the previous day's close. It usually just screams panic.
Okay.
And the market hates uncertainty. This deal brings a truckload of it, but, and this is key, if you look past that initial panic, there's a strong argument this is a classic overreaction.
Okay, so let's unpack this deal first, because frankly, it sounds like a corporate soap opera.
Right.
Why does Netflix even want Warner Bros. Discovery?
Right.
And Netflix is already the king of the hill. They basically won the streaming wars. Why invite all the headache of a legacy studio?
It's about dominance.
Yeah.
I mean, pure dominance. Specifically, it's about intellectual property IP and the power of the bundle.
The bundle?
Think about it. Netflix has the distribution. They have the eyeballs. They're the utility. But Warner Bros., they have HBO. They have a century of film history.
They have Harry Potter, DC Comics.
The whole prestige library. Integrating that IP into the Netflix engine, I mean, that creates a content library that nobody else can even touch.
So it's the ultimate power move. You take the prestige of HBO, The Sopranos, Game of Thrones, and you put it on the global platform of Netflix.
Exactly. It fortifies their dominance. It's about being the default utility for entertainment. If they own that library, churn, people canceling their subscriptions goes down even further. But like you said, it is not a straight shot. This is where it gets messy.
Messy is an understatement. I was reading about the pushback, and it's coming from, everywhere. You've got Ancora, this activist investor with a $200 million stake, and they are not happy. They're pushing back hard.
Well, activists usually do when they smell a deal that might dilute value or add too much complexity. They want efficiency, not empire building. They're looking at Netflix's clean balance sheet and just saying, don't mess this up.
And it's not just them.
No, not at all. You have rival bidders in the mix. Paramount and Skydance are circling, creating this chaotic bidding environment. It's not just Netflix shopping, it's a brawl.
And let's not forget the government. The DOJ and the Senate are reviewing this. I mean, regulatory heat is never good for stock sentiment.
Never.
It creates this cloud over the company where investors are afraid to touch it until the dust settles.
No, it's not good. And that's reflected in the headlines we're seeing right now. If you look at the market context from just yesterday, February 12th, the sentiment is, well, it's mixed to bearish.
I saw those. Netflix faces Warner Bros. Discovery battle as stock pullback tests investors.
And the biggest obstacle to Netflix acquiring Warner Bros. Discovery, it feels like the market is focusing entirely on the hurdles.
Which is natural. The market sees risk, regulatory risk, execution risk, bidding war risk, and it sells first, asks questions later.
Exactly. But this is where we need to put on our analyst hats and ask the real question. While everyone is panicking about the merger rumors, what is the actual business doing?
That's the pivot. Because if the deal falls apart, or even if it goes through, you still own the underlying business. So let's look at the financial fortress behind all the drama. Is the house actually in order?
The house isn't just in order, it's a mansion printed out of money. If you look at the full year numbers for 2025, the disconnect between the stock price dropping and the business performances, it's stark.
Hit us with the numbers.
Okay. Revenue for 2025 came in at approximately $45 billion.
$45 billion.
That is up 16% year over year. For a company of this size that's been around this long, 16% growth is incredibly healthy.
That is massive. But revenue is vanity, profit is sanity, right? at the bottom line.
Operating income hit $13 billion. We are seeing margins nearing 30%.
30%.
Now, just to define that for a second, a 30% operating margin is often considered the magic number in software and services. It means for every dollar they earn, they keep 30 cents after operating costs.
An efficiency machine.
What total efficiency machine?
And cash flow, because that's what really matters for keeping the lights on, for making those expensive new shows without borrowing money.
This is the jaw dropper. Trailing 12-month free cash flow is sitting at a massive $9.6 billion.
Nearly $10 billion in free cash. That is why I like to call this the cash cow theme. I saw they generated $22 billion in gross profit alone.
It's a cash generation engine, and the projections are even wilder. I mean, estimates suggest free cash flow could hit $21.5 billion by 2030.
Okay, hold on. Let's pause there. $21.5 billion in free cash flow. That is an astronomical number. What does a company even do with that much cash? At some point, you run out of movies to make.
Well, that's the fun part for shareholders, right? You reinvest in content, sure. You make sure you have the best shows, the best tech. But once you've saturated that spend,
You buy back stock.
you buy back stock, massive amounts of it.
And for you, the listener, who might not be familiar with buybacks, why is that good for you?
Just think of a pizza cut into 8 slices. If the company buys back 2 slices and retires them, now the pizza is only 6 slices. But the pizza is the same size, so your share of the company just got bigger and more valuable without you doing a thing.
It increases the earnings per share.
For everyone left holding the bag, exactly.
But let me get this straight. You have a company growing revenue at double digits, printing cash, potentially buying back its own stock, and yet the price is down 16% because of a rumor about a merger.
That's the fascinating disconnect we're seeing, and the momentum is still there. In the most recent quarter, they beat revenue estimates by 0.67% and beat earnings per share EPS by 1.82%.
So they're not missing targets.
They are crushing them. The projected revenue for the current quarter is $12.17 billion, which would be another 15.4% jump year over year.
It's relentless. But we have to ask, why are they winning so hard? I mean, Disney is there, Amazon is there with Prime, Apple's throwing money around. Why is Netflix still the king?
It comes down to the moat and the engine. We talk about moats in investing, the thing that protects your castle from invaders. Netflix's moat is scale.
How big are we talking?
Over 300 million subscribers.
Wow.
And here's why that matters mathematically. It's about a concept called content amortization.
Okay.
Let's use an example. If Netflix spends $100 million on a blockbuster movie,
Like Red Notice or something huge.
right, they spread that $100 million cost over 300 million users. It costs them roughly 33 cents per user to provide that movie.
Okay, that makes sense.
But if a competitor, let's say a smaller streamer with only 50 million subscribers, wants to compete, they also have to spend $100 million to make a rival movie.
Right.
But for them, it costs $2 per user to deliver that same value.
So Netflix is paying quarters, and the competition is paying dollars.
Exactly. Netflix gets significantly more value out of every single dollar they spend than anyone else can. That is a brutal advantage. You literally can't spend your way out of that hole if you're a competitor. Your math is worse from day one.
And it creates a sticky ecosystem. The switching costs are high because everyone talks about Netflix shows. The network effects are real. You don't want to be the only one at the water cooler or on the Zoom call who hasn't seen the latest hit.
Precisely. It becomes a cultural utility.
Speaking of keeping it fresh, I saw a headline that caught my eye. Could Netflix stock help you become a millionaire? It talked about new growth levers. Because let's be honest, for a while people thought Netflix was mature.
Right, done growing.
Yeah, the narrative was that everyone who wanted Netflix already had it.
Far from it. They found 2 new gears that completely changed that narrative. First, the advertising tier. They're scaling that up massively, tapping into a whole new segment of customers who are price sensitive but willing to watch ads.
Which is huge because it opens up markets where maybe the full subscription price was a barrier.
Exactly. And second, the crackdown on password sharing.
Oh yeah, that was controversial at first. People were threatening to cancel left and right. Love is sharing a password. Remember that tweet?
They threatened, but they didn't leave. Financially, it was a masterstroke. It converted millions of freeloaders into paying customers.
And those 2 levers are sustaining double-digit growth.
Even as the core market matures, they are projecting 12 to 14% revenue growth for the full year. That is not a stagnant utility company. That is a growth stock.
So we have a cash machine, a massive moat, new growth engines, but the stock is down. Let's talk valuation. Is this actually a deal right now? Or Is it a value trap? Something that looks cheap but is actually broken?
If we look at the quantitative models, the answer leans heavily towards deal.
I'm looking at the chart, and we are testing some serious support levels here. We're hovering near that, what, $75 to $82 range? This feels like a psychological battleground.
It is. But if you look at the valuation checks, the source material indicates that 5 out of 6 undervaluation checks are positive right now.
5 out of 6. That's pretty compelling.
It is, and look at the forward PE ratio. That's the price to earnings ratio based on future estimates. It's sitting around 26x.
Okay.
Now, 26 times earnings might sound high if you're looking at like a bank or an oil company, but for a tech media company growing earnings at 15% plus, that is actually quite low.
It's cheaper than it has been in a long time. Usually, Netflix trades at a massive premium.
Exactly. It's essentially growth at a reasonable price. And if you run the models forward to 2030, based on normalized multiples, the price target is sitting at $166.
Wait, say that again? 166?
$166.
That's like a 102% upside from where we are roughly right now.
Correct. If the thesis holds, you are looking at a potential double over the next 4 years. And that is why the smart money is watching this volatility so closely.
Speaking of smart money, what are the big institutions doing? Are they buying the dip? Or are they running for the hills?
It's interesting. We don't see specific cluster buying in the filings just yet, so no massive insider purchases screaming buy. But the search interest and the trading volume are incredibly high. Netflix is one of the most active stocks in the S&P 500 right now.
So they are circling.
They are watching. High volatility usually scares off retail investors, the regular folks, but institutions love to pick up shares when the market overreacts. The smart money is likely waiting to see how this Warner Bros. Drama plays out, but they are definitely paying attention.
Okay, so that's the bull case, and it's a strong one. But my job is to be the paranoid friend. What could go wrong?
Yeah.
Give me the bear case. Why shouldn't I buy this?
It's important to balance the view. There are real risks. Risk number 1 is the deal itself.
The Warner Bros. Deal again.
Right. If it goes through, Netflix, which currently has a pristine balance sheet, suddenly takes on a lot of leverage. They'll have to issue debt, and debt adds risk.
That changes the math.
It changes the math significantly. It reduces their flexibility to do those buybacks we talked about. Instead of returning cash to shareholders, they're paying interest to banks.
And if it fails?
If it fails because the DOJ blocks it, or if a rival swoops in, the stock might remain volatile for a while. The market just hates deal limbo. It creates a narrative overhang.
What about the business itself?
Yeah.
Any risk that people just stop subscribing? Or they run out of people to sign up?
That's risk number 2, growth saturation. We are seeing estimates for subscriber growth moderating. They are projecting about 11.7% growth compared to 16% in 2025.
That is a slowdown.
It is. The law of large numbers eventually wins. You can't grow at 20% forever. And if the ad tier doesn't gain traction as fast as they hope, margins could slip.
I saw a headline about that. If you'd invested $100 in Netflix 5 years ago, signaling that maybe the glory days are over.
Exactly. We aren't in the explosive startup phase anymore. It's a mature giant now. But I have to qualify this. Even moderating growth for Netflix is better than explosive growth for most other media companies.
A slowdown for Netflix is still a sprint for anyone else.
A sprint for anyone else, yeah.
Fair point. So, we have the risks, we have the rewards. What should we be watching in the next few months? What is on the catalyst calendar?
3 big things. First, earnings. The upcoming consensus EPS is $0.76. We need to see them hit or beat that.
Okay, so watch the earnings print. If they miss, look out below.
Second, regulatory milestones. Any news from the DOJ regarding Warner Bros. Is going to move the stock. And if the government signals they might block it, the stock might actually pop up.
That is interesting. So a no from the government could be a yes for the stock price.
Paradoxically, yes. It removes the uncertainty and the debt risk. And third, the macro factor. As interest rates stabilize, we are seeing a sector rotation back into media. Investors want cash-generative companies.
And that favors Netflix.
It does.
All right, we've covered a lot. The soap opera merger, the cash cow financials, the valuation cap, the risks. I need the final score. What is your verdict?
Taking everything into account, the pullback, the fundamentals, the long-term compounding, I give it a bullish 8/10.
An 8 out of 10. That is confident.
It is a high moat cash cow.
Yeah.
The 16% pullback looks like a classic buying opportunity. Even if the merger fails, you're left with a standalone business growing earnings at 15% plus.
My heads I win, tails I don't lose much. scenario.
Exactly. And looking at a multi-year horizon from 2026 to 2030, the path to $166 seems clear if they just keep doing what they're doing.
So the elevator pitch is ignore the noise, follow the cash.
That sums it up perfectly.
Before we go, I want to leave everyone with a thought. We talked about Netflix potentially buying Warner Bros. Discovery, if that happens. Aren't we just effectively returning to the days of cable bundles? I mean, you pick one giant bill to one giant company for everything. We cut the cord just to plug it back into a bigger machine. And if they don't buy them, can anyone else actually catch them? Or is the race already over?
That is the multi-billion-dollar question.
Thanks for joining us on Smart Wealth with Joshua.
Thanks for listening.
We'll see you in the next one.